Hey, this is Sasha. Thanks for joining me in today's video. What we're going to do is I'm going to share with you how to get double dividends. So basically dividends times 2 using the power of options. So stay tuned. Okay, so before we get started, I want you to understand how a dividend really works, right? So let's say you're interested in purchasing a stock like McDonald's. Okay, a lot of times what happens is 4 times out of the year, you get a dividend. So, first time out of the year comes out, you say, oh, okay, well, I'm gonna get a dividend. So boom, money comes in to your pocket based on the number of shares you have. So let's say you have 100 shares and the stock, for conversation's sake, pays 50 cents per share. You go ahead and you make $50, okay? Because 50 cents a share, you got 100 shares, you make $50. Second time comes around. So, this could be April time. So again, you get more money. So you get another $50 and another $50 and another $50. So you only get dividends 4 times a year unless the stock is weird, wacky, or something else is going on. But in general, you're getting it 4 times a year. Using this McDonald's example, how do you make more money from McDonald's by using the power of options? So how do you multiply this times 2 if you have stock shares? So I'm going to share with you this concept, and this concept really is called covered rights. You could also call it a covered call strategy. If you already have stock, this strategy will work just fine. And basically, it'll multiply your dividends a little bit more. I'm not saying you're going to get exactly 2 times, but you'll be able to make a little bit more than just the dividend itself by using the power of options. So let's see how this really works on screen and go from there. Now, before we get there, keep in mind, if you want to learn more about options, definitely check out our website at tradersfly.com. And you can scroll down and you can see we have a ton of great stocks all about options, stock trading. Check it out, help us out, support us, and that way we can make other great free videos as well on YouTube. So anyways, that's at tradersfly.com, and you can go to that link right there. All right, so when this strategy, and we're looking at this strategy specifically, let's just use McDonald's as an example. So normally you go ahead, you want McDonald's, and you want to go ahead and buy 100 shares. So I'm going to go ahead, analyze this trade, and we're going to go and do 100 shares. Okay, now, if you want to look up, let's say, McDonald's dividend, the normal dividend here, and if you look at kind of the dividend history and what it's paying out, you can see here the dividend yield is about 2.6%. Okay, so this will give you a lot of details. You could also look it up more on things like the NASDAQ, which will tell you a bit of a breakdown of, okay, well, it's basically getting a cash amount of about a $1.25, and here's these declaration dates, payment dates. So you're getting a $1.16, so and a $1.25 recently. So about a $1.25 per share. So you have 100 shares, you get a little bit more, $1.25 for it. So now, how do you make a little bit more than that? So every quarter you're going to get a $1.25 for these shares, for every share that you have. But if you want to make a little bit more, here's a covered call strategy, or writing covered calls. In other words, the way this strategy works is if I go ahead and sell some premium up ahead, especially if McDonald's, let's say, is at all-time highs, maybe you think it's going to pull back, maybe you think it's going to stall, then you could do this 6 months out of 12, you could do this 10 months out of 12, you could do it 2 months out of the year, whatever your choice is, and you could do it really close or really far out. So the whole point behind this strategy is I'm going to sell something further up. Right now, the stock price is $193. And I'm going to go ahead and sell something at, I could do it at 210, I could do it at 205, depending on the strikes, I could do it at 200. And I'm selling a call at those levels. And what's going to happen is when I sell that call at that level, that's going to force me to give up stock if the stock price goes above it. Now, if it never gets or hits that level and doesn't stay above it, I get to keep the premium and I get to keep the stock. If it goes way above it, well, the downside is I missed out on some stock profit gains, because if the stock shoots up to 230, I would have to sell that stock at around 200 or 205. So let's see what we can do here. So here's my option dates. Here's the calls. I could go ahead and sell one about 37 days out. This one is right here. It says 37, so that's 37 days out. In this case, this is the December, but you'll be watching this video sometime in the future. So right now stock price is 193, okay? And I could go ahead and sell some premium. I would get $2.56, or in other words, $256 for at the 195 strike price, because that's really close. It's got a 40% chance of hitting, and being in the money. So if you want to keep your stock, you go further out. Now you get less money, but you go further out. If you're okay with getting rid of your stock, well, what's going to happen is if I sell one super close right here, and we sell a single, go ahead and analyze that trade. It's really close, so you could see right next to the price almost. So if it does go about above that 195 level and stays above it, well, I don't make any more money from the stock. I still get to keep the premium, and in this case, I make an extra $256. And I could make that every month. In general, way more, or just a little bit more than the dividend, but chances are I'm gonna lose that stock. So if you don't wanna lose the stock, you could go to maybe about the 200. Now in this case, you'll make $111 because you're selling 1.11 on your premium. Remember, each share controls 100, each contract controls 100 shares. So that's why you gotta have at least 100 shares to do this. Now, if you had 200 shares, you could sell just one of these, and that way only, you have half stock, and you have selling one contract for premium. So that way, if the stock does continue to keep going, you only lose 100 shares out of your 200. So that kind of is nice as well. So you can see that profit picture will continue to move. So that's the cool thing about this strategy is that, hey, I could do this every month, every 30 days. I could do it every 60 days. Let's say we go out even further. I could go to January. Now, if I go further out in time, instead of December 37 days out, I could go 65 days out. Now, what I could do here is I'll make a little more on the premium side, but of course I have to wait a little longer. So here I could go to the 200 or even the 210. That'll give me 51 cents, so $51. This will give me $215. So you could see, it's a 10-point spread difference there. And you kind of have to, guess, is the stock going to continue to explode? Or is it gonna kind of stay and hang around? So it's another way to also hedge your position a little bit as well. So if things continue to move down, this kind of protects it a little bit. So here in this case, if we went to January, look how far out it is. The current price is 193. That stock's got to jump almost 10, 20 points, and then I would lose the stock, but I don't get as much premium. If I tighten it up and go to, let's say, 200, well, in this case, I make $215, and that is about, 60 days, 65 days. But chances are I might lose that stock. Now, I could go ahead and get out of it early. Like, let's say this stock hangs out, and then it starts moving up. Well, chances are with time decay, you see what's going to happen is that white line will continue to get closer to that green line. And I might still be profitable about $165 a few weeks into it. And then I could get out of it if the stock continues to move up and buying back. I won't get my full $2.15 on the position, but I'll get some of it. So in other words, you'll get dividends from the stock and you could sell covered calls. And it really gives you the power of almost 2 dividends if you think of it that way. And this is a great strategy to do if stocks don't have a dividend, to sell covered calls. So that way you kind of get a synthetic dividend or a dividend substitute for stocks that aren't paying out dividends. So anyways, thank you for joining me. Remember to go ahead and check out the Traders Fly website right here, because if you check that out and take a look at some of the books and some of the courses that we have available, definitely a lot of great stuff. We even have some classes coming up very soon for more education and deeper learning. Thanks again, and remember to do what you love, contribute to other people, but most importantly, live life abundantly. Remember to hit the subscribe here, to subscribe on YouTube, or join us on our newsletter list so that way you don't miss any news, announcements, and discounts by clicking the link over here. Thanks again, and I'll see you next time.